Fund manager at Sherkhan. Anand Kuchelan is looks at the derivative side of things. Vice President Quant Research at Fiduciary Euromax Capital Markets. Morning, gentlemen. Thanks for being with us. Rohit, let me start out with you. Big cut today, 2% off on the indices, no brainer. But what after that? Wait out for a bit because after a 2% fall, it really needs a fair bit of conviction to actually start shorting or selling this market. And especially so, given that today is a Friday, a lot of stuff happening on the global front.
There are a couple of things to understand here. One, of course, is shorting, which is a short-term activity, and second is whether you would be investing at all, which is a longer-term activity. On Monday, I was saying that if you actually broke 49.80 for the previous low, that would confirm a target of 4,500. So I think that remains my target, that we are heading close to 4,500. Will we go below that? We'll figure out as we go along. And the second one is, over time I've been saying there are various divergences on the medium-term charts, from breadth to the intermarket divergences between the small cap and the leading indices and so on. And most of them telling you that it was a risky time to be invested. Even now today, someone tells me, should I buy today for a 3 to 5 year horizon? My answer will be no, because the risks have not gone away and nobody is pricing in the higher end of the risk. People are only pricing in the lower end of the risk, and that's still a problem. So should you go short today is another question, because depending on where the market opens, risk rewards might not appear favorable. But if you ask me, is the market going to keep falling next week? My guess would be it probably is, because the targets are still far lower. But one could really lower his stop loss to closer to the 17,000 mark now. Or I think once you break the low of the last 2 days, you would typically move it to yesterday's high, since yesterday was a positive close. Swing traders would short-term swing traders would just move the stop loss today to yesterday's high, and then look at the risk reward depending on where the market opens versus the stop loss to the target. And if it's still favorable, then you might still consider shorts even at that level.
So, let's talk numbers, Rohit, then. Today, you will get a 2% odd cut right at the word go at opening. From there, which probably will take you close to about 4,840, 4,850 sort of levels. From there, you're saying that we probably still get to 4,500. Even if somebody asks you today that, well, should I buy with a 3 to 5 year horizon, you'd say no, because risks are not out of the system. So both the slightly longer and the near-term view are actually collapsing into one. Essentially, that's what I'm understanding from you. Correct me if I'm wrong.
Yeah, that's right. Both are moving into one. And yesterday's high of 49.50, like I said, would be a stop loss. So say if it opens at 48.50, that's a 100-point stop loss, and we are looking at the downside to 4,500. So it would still appear favorable with a 2:1, 3:1 kind of risk reward, depending on the appetite of the person taking that trade.
So you're saying even at about 4,840 odd levels, if the market gets to that, the risk reward is still favorable for you to actually sell this market?
From an index point of view, yes, it still would be. And in fact, the view that I made up yesterday, looking at doing a little more time analysis, is that I'm also able to set kind of time horizon for the declining market. What we have seen, because I've seen the kind of pattern which has occurred from April to now twice in the past, where you see the market fall, then it retraces 60%, fall, retraces. After two significant retracements, the final leg down typically lasted for 4 to 5 weeks. And the current week, the week which we are ending today, is just the first week. So I think you have at least a minimum of 3 more weeks in which you're going to see the market end the week lower than the previous week coming ahead of us. So I'm looking at 3 more bad weeks ahead. And whether that leads to us stopping at 45 or do we head a little below that is something that only time will tell.
From any of the indicators that you track, Rohit, this market is not getting, after about a 9.5% odd cut from 5,400, the market is not giving you signs that it is oversold in the near term. That's not a, or even if it is giving you, you're saying you don't want to play that.
Oh no, it's not giving you an oversold indication. You see, what happens is the simplest technical indicator, which I think everybody on the street now understands, is something called the RSI, or the relative strength index. Typically, people would say that oversold below 30, and if you go back and look, several bottoms occur between the 25 and 20 range. Where is it today? It's still above 40. Why? Because you see, there's something called as creating space for the fall. Whenever markets bounce back, the RSI can sometimes rise faster than the price itself. And that ends up creating space for it to still fall lower before it gets oversold. So all the bounces that you have seen in the market since the April high have not gone to a new high, and each one of them has ended up creating more space for the RSI to still reach the oversold zone. So it's just not getting there, and that is why you're not really getting oversold readings. The same is happening with breadth. Breadth is a little longer horizon indicator. If I just take the 40-day average of the AD ratio and plot it, it's been making lower tops since somewhere in July was the highest point. So the first lower top occurring in October, then the second one in Jan, and the third one in April. But is it oversold? The typical reading where we see at least a medium-term bottom from where you can get a 10-20% rally, that reading has just not occurred for the last several months, and it's not even there now. So how do you call a bottom? Did you get any oversold reading on any of these indicators?
Okay, interesting points there. Rohit, the other point is, let's talk from a slightly longer term perspective. People are getting worried that, well, is this, from a fundamental side, is this credit crisis too? Is this a repeat of what we saw in 2007, so on and so forth? Have you gone back and looked at what happened then, or chart signaling, flashing warning signs in that same respect? Some have even said, well, this is, let's actually look at what happened in 1937 and stuff. Are you dusting off charts? If not then, at least 2007, have you looked at that? And what do you make of it? Is this looking like it could probably go that way?
Yeah, there's a lot of analysis and work available on what happened in the 30s, technically what happened in terms of actually in the debt crisis during the 1929 to 1932 period. And second is, what I noticed, at least on the US charts, is that the rate structure of the last leg of 2007 from probably July to October, and the final leg between January and April on the S&P and the Dow had a lot of similarities in the way they formed, the wave structure, the pattern, the targets that they achieved, and the way they actually falling, both of them forming. S&P formed an expanding triangle, a multi-month expanding triangle even in 2007, and it formed the same kind of pattern even now, though it's not broken down of that expanding triangle. And essentially, if I look at 2007, the real crack in the Indian markets in Jan 2008 actually occurred on the day that the S&P actually broke the lower line of that pattern. So we are right now the markets coming close to those levels on the US. They've still not broken the lower line. So I think that panic stage would probably be a couple of days away in terms of what the similarities of pattern. And since you asked on the debt side, probably these scenarios are not same, but what the studies that I've read show that you're in a long-term deflationary environment where you're actually going to see contraction of debt, contraction of money supply, which will eventually lead to contraction of CPI numbers. We're already seeing that in the US data. If you see, CPI has done its lowest number in decades in terms of giving a negative CPI growth. So the deflationary environment has been set, and it has various stages. First it started with the financial system, now it's moved to the sovereign system, simply because most of the debts of the financial system were being transferred to the sovereign level. Now when does it go from a problem in Europe to the US? It could be months, it could be years. But the writing on the wall that I think which has come in the first 2-3 weeks of May is that the only solution to these problems is that you need to reduce debt. All these austerity measures which have been announced simply mean that a large part of Europe goes into recession in the next 3 years if they all sign up for these measures. And it's obvious if they do that, that's the only result that can happen. So if you're going to get one entire region going into recession and then you're having US which is already showing signs of deflation, those risks are not being fully priced in at all in terms of what effects they will have on India. I think the clearest write-up was by Swami Nathan Ankleshwar Iyer just yesterday in the Economic Times, saying that if even US world growth slows down, you would see Indian GDP not even grow above 7 to 8%. So And that's the minimum risk. We are not even priced in the downside.
Okay.